I'm Matt Bichard in Seattle for NAREIT's 2018 ESG Forum. Joining me today is Mario Lopez-Alcala, Vice President and Senior Analyst with MSCI. Mario, thank you so much for joining us today.
Thank you very much to you and to NAREIT for the invitation.
Now, can you start by briefly describing what MSCI does and how ESG factors into those efforts?
MSCI is a financial services company that for over 40 years has provided research-based indexes and analytics to the world's leading investors and to help them build and manage better investment portfolios. MSCI ESG Research is a subsidiary of MSCI, and we also build on 40 years of experience on analyzing ESG factors and how they could impact corporations.
And could you elaborate a little bit on what MSCI's ESG research coverage is and how does the company conduct its research?
MSCI ESG Research covers about 6,500 companies across the world and across industry sectors, of which 550 are property companies, 770 if you count also the subsidiaries. We start our research with an in-depth corporate governance analysis. We focus on the exposure that each of the industries have to the most significant E, S, and G factors. We focus also in the exposure, meaning that we not only look at disclosure, we look at what are the most significant environmental, social, and governance factors that each of the different industries face, and depending, of course, on their business lines and where they are operating, and how well these companies are managing this exposure to environmental, social, and governance risks and opportunities. And finally, we identify what are the leaders and the laggards in managing this exposure in each particular industry.
Now, sticking with property companies in ESG, what are some of your more compelling research highlights?
Well, there are several of them. I would like to highlight three. The first one is that using our corporate governance analysis, we have found that companies where we have concerns in terms of their board's ability to avoid conflict of interest because they have executives on the board, they don't have an independent audit or pay committee, or they have an entrenched board, these companies could be acquiring properties of lesser quality, given that the change in the growth rate of their earnings lacks the change of the growth rate of their assets when you compare it with companies that we don't have those concerns. And this trend is much more prevalent in externally managed funds than in internally managed ones. Second, I would like to highlight a trend that we see in human capital management. Companies that we have identified as laggards in terms of their policies when we look at human capital development, these companies experience lower profitability and lower productivity per employee when you compare them with companies that have a stronger human capital development policies. And then the third highlight I would like to do is in terms of the mega trend of urbanization. When you analyze companies with respect to this mega trend, we have found that companies that have stronger urban site investment criteria in their property portfolios, they also exhibit stronger results. And the same is true for companies that have made some inroads in including affordable commercial and affordable residential options as a diversification strategy. Now, the bottom line of these three highlights is, as you can see, that ESG in the property industry goes well beyond environmental, purely environmental issues.
Mario, thank you so much for joining us.
Thank you very much for your time.
For more on ESG related issues, be sure to visit NAREIT's website, REIT.com.